G'day everyone, welcome back to Pete's Investing. Today's strategy, we'll be looking at the MACD. That's the moving average convergence divergence indicator, and how to enter and exit the trade, and how to average down. First, don't forget to hit the subscribe button, the notification bell, and like the video. And that's where you can find our videos on these playlists. And then in there we've got the indices, share price reviews, and strategies we follow. And under the strategies, that's where we include, such as this video, look at the simple trading strategy, the average down process, and some money management ideas. We're not offering financial advice, it's purely an educational video series. So let's get started. First of all, what we cover. I want to introduce the topics. So we're going to look at the entry strategy. Now, there's thousands of entry strategies to follow, and we're just covering a few of them at this point. In this particular video, we're looking at the MACD as the entry strategy we're going to follow in today's video, and test it along various instruments. We also look at the exit strategy. Now, why is that? Sounds obvious, but many videos out there don't show when to get out of the trade. They show you very effective entries, which is all fine and good, but when to get out at with some sort of level of profitability. So we're going to show you some an effective exit strategy. As well, we look at the average down strategy as part of our trades. So again, we're not using stop losses, and instead we use the average down approach. Now, with good money management skills, that's a very effective way of trading, or investing, I should say. So the average down approach can be very effective if you do it right. As part of the strategy also, we backtest. We look at a sample array of stocks on a daily time frame. We look at some indices on a 15-minute time chart, and also some FOREX trading on a 15-minute time frame as well for you FOREX nuts out there. Now, I personally trade on a daily with stocks. I also trade on 15 minutes with indices, but I only go long on those two instruments. I don't go short, and I'll explain why that is the case in a minute. I avoid FOREX as well. Now, if you do it properly, you can still make money using this strategy using FOREX trading. But again, with stocks and indices, going long only, when they pay dividends, you receive the dividends. So those dividends you receive are additional to whatever profits you make from the trade itself. If you go short, and I can introduce short videos in terms of going short, that is buying high and selling low. But again, when you go short stocks and indices, you pay out dividends when they're due. So if someone's going long and you're going short, you will pay out the dividend to that person going long. In FOREX, they don't pay dividends. They only charge you holding costs and administrative fees. So there's no real side benefit for holding anything in particular for too long. Hence, I only go long on the stocks and indices. Anyway, you can still make money using FOREX trading. You follow the strategy. Just bear with me for a minute. And likewise, we look at the drawdown and funds required. So based on the average down approach, we want to make sure we've got sufficient funds in our accounts to trade effectively, getting our profits, but also without getting burnt. And I'll show you how that can be done. And lastly, but not leastly, what sort of estimated returns we can anticipate. Now, in the returns I'm going to show you, we look at, it doesn't include dividends, which are used in our long trades, but it does include any holding costs, and also any brokerage is also accounted for when you buy stocks. So let's get started, and I'll show you the approach we use for the strategy we're approaching. So look, this is the first we're looking at the daily charts in these stocks we're trading. And again, it's the sample array of stocks. We're not suggesting you buy these. And I've got this sample of stocks because some of these doing quite nicely, others are going sideways, others are going in a southerly direction, going down. So I've tried to pick a various basket of various stocks to show different results across these. Before I explain the numbers here, let me just explain the strategy. So first off, we look at the MACD, moving average convergence divergence histogram, going greater than 0. So that's the entry. So what does that look like? So if you look at this chart here, this is a stock chart on a daily time frame for the CBA, Commonwealth Bank of Australia. You can see here the MACD indicator, which is pretty much default in most share trading platforms. When this little histogram here breaks above zero, this is the zero line. When that breaks above zero, we enter the trade as per this example. And this up here is, this is the stock price chart. This is a profitability chart, and our baseline is 100,000. And this is, when you see these bars, this is where you enter the trade. That's what shows you've entered there 22 shares. So in this case, we're trading $2,000 lots. So every time we enter, we're buying $2,000 lots of the CBA or any particular shares we trade. And that's why back here, dollars per contract, you're paying $2,000 per entry. I'll explain this in a bit more detail. So going back to the chart, when the MACD breaks above zero, we enter the trade. Now you'll notice the price chart went down. So potentially, had you had a stop, the problem with stops is you need to be fairly stringent and pretty lucky to put an effective stock somewhere down here. Now, where do you put the stop? Here, you might say in the latest swing low. So if you had to put it down there, you most likely would have got stopped out there. So it's a bit of a subjective matter in terms of where to put stops. Now, in our case, we're not using stops. We're simply going to use the average down, and I'll explain what the average down is in a minute. So we enter the trade there. The price goes against us, recovers, goes down sideways, then it starts breaking up. What I've drawn here is just a perimeter of minimum profitability. So we want to make sure we break above this level of profitability before we close out the trade. Now, the exit strategy, going back to this, the exit strategy is when the MACD breaks below zero. So again, when the MACD here breaks below zero, you exit the trade. So if you want to be strict and have a stop loss method in place, you could say enter there and exit on that bar, because that histogram broke below zero, if you wanted to be strict with stop losses. We're not using stops, we're letting it go. So the price goes against us, the moving average again breaks above zero. We don't enter any more trades because one of our criteria is if it's less than the entry price. I'll explain the average down process in a minute, but we don't enter any more trades in this case. Let it go. The price starts accelerating up, and you can see here it breaks below zero. We're still below our profitability level, so we don't exit. When the price starts accelerating upwards, the histogram is above zero. We let it go until it gets to this point. Histogram breaks below zero, and we exit the trade. So that's our minimum level of profitability. We've reached that, and we exit the trade there. So again, when the close is greater than position price and the histogram is less than zero, we exit the trade. So our profitability is in the positive, in other words. Now, in terms of the average down approach, the entry and the exit is the same. So let's look at an example of the average down approach. So let's look at this little trade here. This happened during the start of COVID. So up here, just before COVID outbreak, at the start of 2020, you can see there, 13th of February, we enter the trade. We enter 22 positions. Again, we're buying $2,000 worth of CBA, which at this point are worth, you can see there, we bought 22, that's a rounding, just round it up to 22 or 23. We bought 22 shares at $88.49 per share. That's about $2,000 worth. That's our first level. COVID hits, the market takes a dive. We don't re-enter the trade until our entry criteria is re-met, but also our close is less than the average price. So in other words, our entry criteria is opened up again for an entry, and that is lower than the initial entry price. That's what it means by that, close is less than the average price. Our histogram is greater than zero, which it is. The histogram breaks above zero. So that's the two criteria so far. The last criteria is the minimum gain of the last 100 bars is reached. That's another way of just a little formula I put in there. What that basically means is, from the previous 100 bars, our average high-low range has been executed. So if you draw it's very roughly, if you draw parallels, some parallel lines, let's draw a line from there to there, say, and we draw another line. in the lows, let's say from there to there, about there. That period there, that range there, this is just roughly estimating. You can do this as I'm doing it now if you really wanted to. And let's say it's down to there. So you're looking at that range there, about 9.26%. So what it's saying is, let me draw another one. From that entry point, let's call it 10%. So anything below that 10% line, based on that high-low range of the last 100 bars, you could say if that histogram had broken above zero back there, say, you would have entered it again. But because the drop has dropped lower than that 10% range, in this case, and it has there, and our second criteria is the histogram is broken above zero, you can enter the trade. Now notice we've now averaged down once, twice, and that's what that signifies there. We bought our first lot of shares there and our second lot of shares there. That's what that signifies. The trade keeps going for a few months until the end of the year, and we've exited the trade there for buying 2 lots of shares. At that point there, that would have been greater than our, again, look at the exit criteria. The MACD histogram is broken below zero, and our close is greater than the position price. And our position price is now, it's no longer that, nor is it that, it's about halfway there somewhere. That's our average price. So our close is greater than our average price, and I won't calculate the average price in this example, but it's broken above that, and our MACD histogram is broken below zero. Now you'll notice it broke below zero there, but that still wasn't above our minimum range of our average price. So you can see there the profitability closed out there at 102,737. So if our baseline's 100,000, 2,737, and it started off with 2,453. So I made about $300 in that trade for that period with 2 entries, 2 lots of shares. That in effect is our average down approach. You can see here as well, this little trade lasted for a few days, entered there. It's hard to see there, but the MACD broke above zero, and there it closed below. Now again, that would have been a very minimal gain, and then it goes back to this point here where it, in our earlier example, entered the trade there and it closed out there at a high profitability again. So that in effect is our entry and exit on one single contract, as in this example, or if you average down, such as in this example where we average down. If you look at the big picture for CBA, and I've started this going back to 2007, during the GFC in 2008, 2009, you can see the biggest impact. We entered 295 positions. So if you count that, roughly speaking, we've entered once, twice, 3, 4, 5, 6 contracts, 6 $2,000 lots. Okay, so where we started our trading with a zero of $100,000 baseline, we closed out at 1,316. So we gained 1,316 in the trade from the start of 2007 to late 2009 for that trade during the GFC. And all these other ones were at single steps. They're all single trades, enter and exit. That's an average down, once, twice. They're all single. There's another average down, once, twice, and so on. So overall, during the period from the start of 2007, we've generated 29.90 Aussie dollars in terms of trading. That includes brokerage, by the way. Whenever you enter and exit, we're paying $8 brokerage in this account, and that's what it shows there. So going back to our table, again, that's our strategy for entry, exiting, and average down. And that's the result there for the CBA. We've entered 6 contracts at $2,000 lots. So in other words, we needed $12,000 total to plug into CBA when we traded. The max drawdown, the CBA, is basically on the profitability from the highest point of profitability to the lowest point in any part of this chart. So you can see there, just drilling down on this during the GFC, just drawing it roughly, let's say from there to there, 48.18 in terms of points. That's roughly drawn. So it's in actual fact, it was 48.56. So if we go back to and run the detailed report, that's how I generate the results. 48.56 was the drawdown. You can see their maximum run up was 76.45. That's pretty much just the opposite. So that would have been from the lowest point to the highest point there. But what we're interested in money management is checking how much of our account is being impacted by that drawdown, as well as how many contracts we entered. So hopefully that explains the number of contracts we enter, the maximum number of contracts during that period, any part of that period. It doesn't mean you have to have 6 contracts across the whole board. But again, in the CBA's example, from the start of 2007, that was the biggest impact we would have had on CBA. That would have been 2 contracts, 2, 2, 2, 2, 2, 3, 2, 2. All the others would have been single $2,000 lots. So again, that was an example for CBA. I won't go through all these other charts, but just an example of how that works. You can see there the revenue generated over the period for all these stocks was 22,655. The maximum drawdown total, which includes the drawdown plus the number of contracts, you can see there that's simply looking at 6 times 2,000 is 12,000. That's what that times that equals all these, plus the drawdowns. The total drawdown would have been 27,285. Now, most of that would have been probably during the GFC, but not necessarily. So what we look at is then the profit over the max drawdown, and that's 24%. And what we do then is look at today's date, and look at the number of months since the start of 2007. That calculates out to 180 months. Today's the 6th of January, 2022. And that's roughly our average revenue per month generated on trading those stocks, or $126 had you traded those using this strategy. I ran the same program for the indices. Now I did this one on the 15-minute time frame, so a lot shorter. The charts start on the 4th of August 21, so it only goes for 155 days. So this calculates per daily revenue. So again, you can see for the ASX 200, it generated 1608. 7 contracts max, and that shows you the number of per contract, what margin is required when you're trading CFDs. So if you bought with the max during the chart, you bought 7 ASX 200 contracts, you would have needed 7 times 369, which is 2583. The maximum drawdown accumulated during that period was 1482. So the maximum amount when it impacted your account would have been 4065. The profit over drawdown was 40%, and had you traded that for the ASX 200, you would have generated about $10 a day trading each of those. They're all trading single contracts each time. You can see that the US 500 traded at the maximum of 10, and so on. So overall, for all those indices, $9,500 with a maximum drawdown of 35. So overall, over 155 days at $62 a day revenue average. I'll quickly show you the ASX 200 as an example. So let's look at the 15-minute time frame. Now we're changing this to show number of contracts we're going to enter. We're not buying $2,000. We're simply entering 1 contract each time, and we're not going to use a brokerage. And you can see here, and this goes back to 15-minute time frame, this goes back to about May 2020. You can see there, that's the maximum number of contracts, 6. This one had back here, had 5. So that's changed somewhat. But basically, the contracts, and again, we need to change that. Why is that changed? Change to 1. And we need to change that to the ASX. So back here for the ASX, it generated 1365. Okay, this is a live chart. We had a maximum of 7 contracts. So ASX, it's dropped a bit, 1608 since I drew this table. 7 contract was the max. The maximum drawdown was 1482. That most likely would have been from that high to that low, 1482. That would have been back in September. But you can see here, most have been single trades, a couple of double ups. This one had 3, this one had 1, 2, 3, 4, 5 contracts entered, and so on. So that's the return on the indices. And lastly, for Forex, for you Forex nuts, this is a return. Now, the Forex market is very volatile. Now, I'll show you the best and the worst of these. Let's look at the Euro US. You can see here, the market's been declining steadily. I don't like trading this one because it's a very volatile market, but you can do it. As you can see here, it's held a maximum position so far of 17 contracts. We're down about 4.5 or 4,200 from our $100,000 baseline. And our maximum drawdown would have calculated our previous drawdown. So far we're down 4.5 almost. So, but we're calculating back on this period here. It's hard to see there, but that would have been our biggest drawdown point. That would have been 331 euro for a Euro US. But we're down about 4,100, as I said. Maximum contracts was 17. And per contract for a Euro US for the CFDs in the platform I'm using is $518. Again, this is very important to understand what you're being charged for your margin requirements. Now, it looks like very low results, but again, we're still in the middle of this downturn for the Euro US. Let's look at the US Swiss franc, which is a more positive outlook. You can see here the market's going more sideways, so more zigzaggy, which is a very effective way of looking at it when trading the average down approach. It's generating 1336 so far in the live market, but when we registered it before, 1328. Maximum 4 contracts entered. So 1, 2, 3, 4. That was probably the maximum at that point, at that level there. And our biggest drawdown would have been somewhere one of these levels, probably at that point there as well. So again, drawdown was 267 Swiss francs. So, in summary, we're using the MACD to trade all of these instruments, the Forex market. But again, you need very tight money management ideas and disciplines to make sure you've got the number of margins required. But also, and that's where your bank account is very important, but also the drawdown requirement. So, and that's why I use $100,000 baselines. So again, just looking at this as an example, this hasn't fallen below our baseline. It's been doing quite nicely, just touched below our 100,000 baseline there. That's why I use 100,000 just to allow for things like Swiss franc, but also for Japanese yen if I was trading that. So you can see here, Japanese yen is going to, the results here would be in yen. That's been doing quite nicely. So it's been accelerating, but where it goes down, we want to make sure we've got enough funds in our account. So that will be 234,000 yen. So again, make sure you follow the money management and drawdown funds required. We showed you the entry strategy, the exit strategy, the average down approach, and back tested on the daily and the 15-minute time frames to show the effectiveness and the revenue generated for each of these. So had you traded all those Forex indices, you'd probably be about break even at this point. Had you traded the indices, you'd be about $62 a day in terms of revenue. And had you traded the blue chip shares, you would have been about $126 a month in revenue. And don't forget, some of these are halfway in their averaging down. Okie dokie. Don't forget to hit the subscribe button, the notification bell, and like the video, and we'll speak to you in a future video.